Module 5. Indicators and oscillators measure trends and provide trade signals. So, indicators are calculations based on the price and or the volume to measure trends, volatility and momentum. Indicators are based on price movements and therefore an additional tool to price analysis. Indicators confirm price movement or trend and the quality of chart patterns, but also provide their own buy and sell signals. So indicators are either leading or lagging. A leading indicator precedes price movements, giving them a predictive quality, while a lagging indicator, such as the moving average example we've seen, is a confirmation tool because it follows price movement. Oscillators tend to trade in ranges from 0 to 100 to make them easy to read, but both lagging and leading indicators provide buy and sell signals mainly through crossovers and less so through divergence with the price. We'll look at that in a minute. A price crossover through a moving average, we've seen that previously of course. This provides a signal, but also two different moving averages crossing over each other provide a second signal. You understand that by now, I'm sure. When price is trending in a different direction to an indicator, e.g. a stochastic indicator, RSI or MACD, this divergence indicates the direction of the price trend is weakening. So the price might be in a bull trend heading higher, but the indicator might be doing the reverse and starting to trend lower, which would indicate that the price trend, although it's still positive, it is weakening. Indicators are best used in conjunction with price movement, chart patterns, and other indicators to build up a complete picture of what is happening in the market to determine future direction and low-risk trading opportunities. Don't base your trade ideas on one single indicator or one single tool. You have to put the whole picture together to figure out the puzzle. The stochastic oscillator is a momentum indicator that compares the closing price to the price range over a given period of time. So in other words, it shows the close relative to the range over a set number of periods. So in a bull trend, prices should tend to close near the upper end of the range. Of course, because prices should be climbing, you want to see them close near the upper end of the range for the day to show that bulls are in control. In a bear trend, the opposite happens. Prices tend to close near the low of the range. Therefore, the stochastic oscillator is designed to follow the speed or momentum of the market. The stochastic oscillator contains two lines. The first line is %K, essentially the raw measure used to formulate the idea of momentum behind the oscillator. The second line is the %D, and that's just simply a moving average of the %K. So the %D is considered to be the more important of the two lines because this is the one that will produce better signals. The stochastic oscillator generally uses the past 14 trading periods in its calculation. There you see an example. As a rule, momentum changes direction before the trend. Therefore, divergences in the stochastic oscillator can be used to indicate potential reversals in trends. So that a rally, a bull market, will start to slow down. It won't just suddenly stop and reverse. That's unlikely. It'll slow down, it'll smooth out at the top, and the stochastic oscillator can help you spot this slowing down in momentum. If the stochastic oscillator is starting to turn lower in a bull trend or is having lower highs when the price is showing higher highs, this indicates that momentum is changing. It's a warning. Price is failing to close in the upper area of the range despite the continuation of the bull trend. So prices are going higher, but they're not closing the upper end of the range, and so it shows that they could be losing momentum. Sellers are coming in at the end of the day to take profit. This is my favorite indicator. I also find it useful for identifying overbought and oversold levels. Note that I only follow the slow stochastic. The stochastic oscillator is above 50 when the close is in the upper half of the range, and it's below 50 when the close is in the lower half. So very low readings, in other words below 20, indicate that the price is near its low for the given time period. High readings above 80 indicate that the price is near its high for the given time period. So how do we use this stochastic as an overbought and oversold indicator? As I mentioned, the oscillator ranges from 0 to 100, making it easy to identify overbought and oversold levels. No matter how fast or how far a market moves, the stochastic oscillator will always fluctuate within this range. It can't go below 0, it can't go above 100. Traditional settings use 80 as the overbought threshold and 20 as the oversold threshold. Readings above 80 for the 20-day stochastic oscillator would indicate that the underlying security was trading near the top of its 20-day high-low range. Readings below 20 occur when a security is trading at the low end of its high-low range. So it's important to note that the oversold readings are not necessarily bullish, and markets will remain oversold for very long periods of time, especially in a bear trend. Closing levels consistently near the bottom of the range indicate sustained selling pressure. So if you're seeing big red-bodied candles, if the market's clearly trending lower, ignore the fact that the market is oversold, especially if we're in a bear trend, of course. You really do not want to be buying into a bear trend just because the market has become oversold. Overbought readings are not necessarily bearish. A market can and will remain overbought for very long periods of time in a bull trend. Closing levels that are consistently near the top of the range indicate sustained buying pressure, so watch for big blue-bodied candles and do not think about selling into a strong bull market just because the market has become overbought on the stochastic oscillator. The next chart, you'll clearly see the strong bull trend indicated by a red trend line to the right of the chart. The stochastic becomes overbought at an early stage of the rally and remains severely overbought. So a trader selling into shorts in this bull trend would potentially wipe out his account. And many traders have made this mistake. I certainly did do in my early days. You do not want to do it. The stochastic oscillator must only be used as a potential buy signal when combined with other technical analysis tools, of course, in a bull trend or a sideways trending market perhaps. Okay, so if the market experiences a negative short-term correction in a bull trend and becomes oversold on the stochastic oscillator, this could present an opportunity to buy back into longs. Ideally, a trader will be looking for suitable support levels to enter this trade rather than just buy blindly. Be patient, put your trend lines on there and all the other indicators and tools that we've discussed, and look for a good, solid support level to buy into a long position. A bounce from oversold conditions in a bull trend can often be very steep, offering quick profits. Note that when the stochastic crosses back above the blue 20 line in the example above, this acts as confirmation of a potential move higher. Some traders would use this as a buy signal, confident that the bull trend has resumed. The stochastic oscillator must only be used as a potential sell signal when combined with other technical analysis tools in a bear trend or sideways trending market. If a market experiences a bullish correction in a longer term bear market, so the price has been trending down, we see a good bounce, it becomes overbought on the stochastic oscillator, this could present an opportunity to sell short again. Ideally, a trader will be looking for suitable resistance levels to enter this trade, not just sell it because it happens to have become overbought. Or in the reverse of the bullish example above, a cross below the 80 line could be used as the sell signal, indicating that the bear trend has resumed. Now we're going to look at divergences. A negative or bearish divergence forms when a new high in a bull trend is not confirmed with a high in the stochastic oscillator. This shows decreasing upward momentum in the trend, as I mentioned before, and could indicate a potential reversal. So in other words, bearish divergence forms when price hits a higher high, it continues going up in the bull trend in other words, but the stochastic oscillator forms a lower high. There we see an example. For timing purposes, we would look for a bearish confirmation, such as a break below an upward sloping trend line, coupled with the stochastic crossing below the 80 line before entering a short trade. Just as a market can remain overbought for long periods of time, several bearish divergences can form, and timing a sell-off on the bearish divergence alone is way too risky. I have lost money trying to do that. Wait for confirmation from candle formations and other technical analysis tools, such as a break below the trend line. Okay, a bullish divergence forms when price records a lower low, but the stochastic oscillator forms a higher low. So this shows less downside momentum in the bear trend that could indicate a potential bullish reversal. The halfway point or the 50 level on the stochastic oscillator is also worth watching. A stochastic cross above the 50 signal, so let's say you've been seeing the market trend lower, but you're getting a bullish divergence. You're seeing the stochastic oscillator starting to trend higher against the price trend, and then you see the oscillator cross back above the 50 line. This signals that prices are trading in the upper half of the range for the given period. It's an added positive signal or confirmation of a continued move higher. Cross below 50, of course, means prices are trading in the bottom half of the period, suggests a negative signal or confirmation of a continued move lower. So if you are short and you see the oscillator cross below 50, it gives you more confidence to hold on to your short position. In fact, the halfway mark can act as a support or resistance area as well. It's not the strongest of signals, but keep an eye on it for confirmation of the trend. So yeah, I wouldn't necessarily execute a new trade on that, but it does help to confirm if you've already got the position on, and you get the move to confirm, and just makes you happy to hold that position. Like all technical indicators, it is important to use a stochastic oscillator in conjunction with other technical analysis tools. Volume, support resistance, and breakouts, etc. can be used to confirm or refute signals produced by the stochastic oscillator. So basically keep an eye on the oscillator, but don't base your trades on it. It's such an easy thing to look at and get a quick idea of the market that you can easily focus on it too much and base your trading decisions on it. That would be the wrong move. We have what we call a divergence indicator when we use a stochastic oscillator. So this is how it works. We are in a bear trend in this particular segment of the market that you see here from August, September down to December of 2016. At the very end, you can see how the oscillator does catch the peaks and troughs. At the very end of this move, in the last sort of month or so, the price is clearly continuing to trend lower, but the oscillator is doing the exact opposite. It's starting, well, it's flattening out and actually, if anything, trending higher. So it's not reinforcing the bearish message here. And as you see, there is more and more indecision in the market in these candles, the way they're closing sort of unchanged here. We've got some dojis. We're not closing at the lower end of the range on all the candles. As you can see, we're getting some shadows down here with the long candle wicks, and we're certainly getting some blue candles in here. So it's indicating that there could be a momentum change, and this is what the oscillator is clearly displaying by starting to trend upwards, certainly flatten, if anything, starting to trend upwards. So this is what would call a positive divergence. The price is trending lower, but this is starting to trend higher, and this will indicate to you that the momentum is potentially changing and there could be a trend change. And of course, in the end, there was a trend change. You should be familiar with how the stochastic oscillator is used to identify the momentum of a trend and how it can be used as an overbought or oversold indicator. We have seen how once a divergence is spotted, we can use confirmation in price to generate a tradable signal. Crossovers are commonly used to identify other buy and sell signals. We know this already. We've seen that in moving averages. In the chart example below, we see how signals are generated when the fast blue line crosses below the slow red line, when prices are overbought. So a break below the 80 line helps to confirm the negative signal, or can in itself be used to trigger a sell signal. Watch out for false signals. Remember, selling short in a bull trend, we know, high risk, and therefore we are likely to get false signals. A bullish crossover of the fast blue line above the slow red line when price is oversold triggers a buy signal. This is a low risk buy signal, as the market is in a longer term bull trend, so we're looking to buy into any weakness anyway. A cross of both lines back above the 20 line is your added buy signal, so you could either add to longs or just be happy to see that as a confirmation of a bullish move. Remember to use these signals with your other technical analysis tools, of course, we know that, and trade in the direction of the prevailing trend. So here you see on my screen I've got the settings for it. I think these are pretty standard. %K periods 10, 3, average period 3, and then %D period is 3. So I'm just going to add that to my chart now. And there you see Stochastic Oscillator at the bottom of the page. This is my favorite indicator, at least, and I do find it useful for identifying overbought and oversold levels as well. I use the slow stochastic, not the fast. Okay, so this is an up-to-date chart of the gold price going back over 1 year. This is a great example, actually. So as the market as the market bottoms out, you can see that the stochastic oscillator is in oversold territory. In other words, it's under the 20 line. So we're aware that it's oversold, and then as the oscillator turns higher and the fast line, the grey one, crosses over the red one, you can see that we accelerate quite quickly, and this is matched almost perfectly in timing by the price move. As we begin to get overbought, there's a little warning that we're getting overbought, and eventually the price does react and has a small correction, as you can see, bringing allowing the oscillator to trend lower. We then bounce. You see we're developing into a bull trend. Of course, we don't know we're developing into a bull trend, so this is something you've got to be careful of. The market will spend a long time above the 80 line when we are in a bull trend, and this is when you've got to be careful. Trend identification is extremely important. If you're looking to sell every time we get overbought and we're in a bull trend, you're going to lose a lot of money. So eventually, when the market does flatten out and it flatlines for a good 3 or 4 months here, this is when the stochastic oscillator is fantastic as a help you spot trade opportunities. So we don't know that it's flattening out, but down here when we bottom out, the oscillator will help us to buy, and as you see, they cross over, which is bullish, and then up through the 20 line, which is bullish, and that will take you, if that was to take you into a long position, that would have worked really, really well. Now, the first peak, not so well. We actually only trade sideways, which is quite common, but that does allow the oscillator to move back from the overbought situation to about the halfway line. Then we rally again, but this time it would have been quite a good opportunity to sell if you combine it with other things. For example, look at that big negative candle up there. A couple of big negative candles, in fact, bearish engulfing. So with other tools that you know from your technical analysis toolbox, that would have indicated that perhaps it would be a good sell if you thought we were entering a sideways trend and the moving averages are actually moving quite sideways. Down we go. You know we're at least in a bull trend because we have been trending higher since December, so you're happier buying into dips, and the oscillator becomes very oversold here, but much way below the 20 line. Crosses over, becomes bullish up through the 20 line, showing some strength. Bang, market takes off again, becomes overbought. You see the pattern. So when we trend sideways, this is very, very well. It's a lot easier to trade this. When the market decides to then take off, you've got to be careful because you can spend a lot of time in the upper band in the overbought territory, and then that can cause problems. You're getting short into a bull market, something you definitely don't want to do. If you are in a bull trend, you want to be buying into dips. This is when the oscillator works. If you can identify that we are in a bull trend and then we do get a corrective phase, become oversold, then this will indicate to you that, hey, look for some buying opportunities. But for timing, you need to look at some of the other tools that I've explained. Again, caught the peak quite nicely here, and we're now catching a trough. So to summarize, this works particularly well in a sideways moving market, or it works well looking for buying opportunities in a bull market, and of course looking for selling opportunities in a bear market. But if this is stubbornly staying in overbought territory and the market is trending higher, do not think about entering a short position. Stick with the trend. If the market is holding in the upper area of the range in the oscillator, then it shows us a lot of strength. Okay, let's move on to Bollinger Bands. I'm not going to go into too much detail on Bollinger Bands because although I've used them in the past, well, I say I no longer find them particularly helpful, but I've started using them again recently, possibly because markets have been trading sideways for so long, and they are useful at least on the daily chart. Bollinger Bands are volatility bands shown above and below a moving average, usually a 20-period moving average. They're based on standard deviation, which changes as volatility increases and decreases. So the outer bands are usually set 2 standard deviations above and below the middle band and automatically widen as volatility increases and narrow as volatility decreases. A move originating after the rejection of one band, one extreme, either the high or the lower band, often tends to go all the way to the other band, but you don't know how long it'll take. Bollinger Bandwidth is an indicator derived from Bollinger Bands and measures the percentage difference between the upper band and the lower band. Therefore, bandwidth decreases as Bollinger Bands narrow and increases as Bollinger Bands widen. A Bollinger Band width squeeze provides a signal to traders and occurs when narrowing bands show volatility has fallen to a lower level. Periods of low volatility are often followed by periods of high volatility. This is very loose, I wouldn't necessarily base a trade on it, but it's just worth bearing in mind. It does help you to clearly identify what's going on as far as volatility concerns in the market just by looking at the Bollinger Bands. So narrow bandwidth can occur before a significant advance or decline. After a squeeze, a price surge and band break signal the start of a new move. So to summarize, a significant move tends to happen when the bands contract and tighten towards the average, a bit like a spring coiled up, and eventually we break out of the bands and volatility increases. As with most indicators, when there is a breakout of the band, the current trend is usually maintained. So if you've gone through a consolidation phase in the bull trend where the market's just trading sideways, as is very, very common and very, very healthy for the bull trend, really just to consolidate, then more than likely when you do get a breakout and an increase in volatility, it'll be in the direction of the prevailing trend. In other words, it'll go higher. This is an up-to-date gold chart. In a sideways moving market, at least, I wouldn't say in a market that's trending strongly upwards or downwards, but in a sideways moving market, a move originating after the rejection of one band often tends to go all the way to the other band, the other end, the band at the other side of the middle. So that does seem to be the case here. The gold is proving that point is there, especially as we're moving sideways. As you can see, bang, bang, bang. We are hitting eventually these lower support bands here, and eventually we bounce back up to the upper band. We hug it all the way to the top and down again. So no good for timing whatsoever. Just because we've hit the upper band doesn't mean it's immediately going to reverse and hit the bottom band. But if it does start to move away, then there is a decent chance it will eventually hit the lower band. And again, if it bounces off there, there's a decent chance we will hit the upper band, as long as we are in a mostly sideways trending market. So here's the dollar yen since the beginning of the year, January 2017, up until where we are now, October the 23rd. Again, a market that has been moving mostly sideways, and you can see the Bollinger Bands have actually done a better job here in the dollar yen than probably they did in gold. This is where we start to see a directional move, not quite so useful. The Bollinger Bands certainly didn't hold in this April low here. We blitzed a little bit below for a couple of days, 3 or 4 days in fact, before eventually bouncing. But when we did hit the upper band in the beginning of May, that worked quite nicely. In fact, we rejected it and came back down quickly to the lower band. Anyway, you can see for yourself, Bollinger Bands have worked well as support and resistance levels most of the time. This is a chart of the DAX future, and as you can see, although we have been in a bull trend, it's been there's been a lot of sideways action at times. And again, the Bollinger Bands have been relatively useful, not quite as good as example as the dollar yen, but it does show that even in trending markets, they can have some significance. And of course, in an upward trending market, you're looking to buy down at support, so it would be more significant when you're trying to find an entry point on any correction. And again, the Bollinger Bands here have been a fairly reliable support area. If you're combining this with other things such as the 55-day moving average here combined with the lower Bollinger Band has been a good support level. And then if you were looking to, if you're quite an active scalper and you're looking to take profit, then when we hit the upper Bollinger Band, it's a decent enough area to be taking profit and then waiting to get back in on the lower Bollinger Band. The MACD Moving Average Convergence Divergence Indicator is the difference between two exponential moving averages, which helps to measure short-term momentum compared to longer-term momentum, signaling the current direction of momentum. The 26-day and the 12-day exponential moving averages are the most common used parameters. Again, crossover signals. The MACD is quite a good indicator and one I think worth monitoring with the slow stochastic, if you can fit them all on your chart, that is. A bearish signal is generated when the shorter term MACD line, the blue line, crosses below the slower signal, or the red line, in my examples anyway. So there we go, we're getting moving average crossovers again, indicating strength or weakness in the market. When the short term MACD line rises above the slower red signal, red line, the bullish signal is given. I prefer to use these signals as confirmation of a reversal of a trend when combined with candle formations. Just as with the stochastic, we need to wait for confirmation of a MACD crossover with, for example, the break of trendline support or resistance. Negative signals in a bull trend make selling short a risky trade, as we know, but they're useful for a potential profit-taking signal. So if you're getting a negative signal, you've got a long position, you might think, okay, I'll take some profit. Let's see if the market heads lower to a support area when we become oversold and we get a buy signal. Buying into longs in a bear trend on a bullish signal is also a risky trade, of course. As we know, low-risk trading is buying into a bullish signal in the longer-term bull trend and vice versa. I will keep repeating that because it's so important. Divergence. Just as with the stochastic and RSI oscillators, the MACD divergence indicates a market may be running out of momentum. Zero, the middle horizontal line. When the MACD crosses above the zero line, this is also a positive or bullish signal, a bit like the 50 line in our slow stochastic example. And when the MACD crosses below the zero line, this is a negative or bearish signal. However, I would not use this as a trade signal. In other words, I wouldn't enter a trade on that signal. Again, I would just use it more as confirmation of the continuation of the existing move, which is helpful if you already have a winning position, as it may help to encourage you to keep the position on in hope of increased profit. The RSI is the relative strength indicator. It works in a similar way to the stochastic oscillator, but I actually find the stochastic oscillator to be more effective. The RSI ranges from 0 to 100 as well. The reading above the 70 level in a bear trend indicates an overbought market and a good chance the price will pull back. An RSI reading below 30 indicates an oversold price in a bull trend, and therefore the bull trend is likely to resume. Exactly as with the stochastic, selling into a short position when the RSI becomes overbought, or buying into a long position when the RSI is in a strong bear trend is high risk and not advisable. Sorry to keep repeating myself, but it's important. So traders look for a divergence between the price and the RSI, but they wait for confirmation before entering the trade. So again, break below trend line, that kind of thing. The RSI may be a useful tool only when combined with other technical analysis techniques. Do not go and base a trade purely on what the RSI is telling you. It's not great for timing purposes. It's only useful as an indicator with your other tools. Okay, the Fibonacci series. This is just a fantastic tool, and you could actually trade only using the Fibonacci series if you had to. So, quick rundown. An Italian named Leonardo of Pisa, or Leonardo Pisano, was born in Pisa, Italy. It appears Fibonacci was a nickname given to him after his death. He grew up in North Africa and helped to introduce the Hindu-Arabic number system into Europe, used today. He completed his book in 1202, which explained the elementary school rules we use today for basic maths. Many European mathematicians of his day were persuaded to use this Hindu-Arabic system rather than the Roman numerals system. Fibonacci is credited with discovering a series of numbers which have been used by mankind for centuries. Its use may have started as early as the Egyptians in the design of pyramids, as well as Renaissance artists. I'm not going to go into how you calculate these numbers, you can Google that yourself, but you must be aware that they are important in the world of trading and financial markets. For some reason, they seem to work. The Fibonacci series is present in physical proportions of the human body and many other parts of life and the universe. There's so many examples of the Fibonacci series occurring in the natural world around us. For example, in spiral formations in the head of the sunflower, the veins in leaves, the formation of shells in a beehive, you divide the number of female bees by the number of male bees, and you will get 1.618. The Fibonacci series frequently appears in geometry, in the pentagons and hexagons in Islamic decorations, and was used in the design of Notre Dame in Paris, as well as many more recent examples of design in architecture. I actually don't know why the Fibonacci numbers work so well in technical analysis, but I know they do work well. Probably it's a self-fulfilling prophecy, maybe because everyone uses them. I've probably used the Fibonacci retracement tool more than any other, and in fact I believe you could identify reliable enough trading levels if this were the only technical analysis tool you used. So as I said earlier, these really are very useful. It may just be that so many technical traders use Fibonacci because they are so easy to plot on a chart that the numbers have such importance and effect on price movement. So how do we locate and use Fibonacci retracement levels in trading? As we have discovered, markets move in trends over extended periods of time. However, no market moves in a clear straight line. Price chops up and down within the longer term trade. Technical traders use Fibonacci retracements to find support in a bull trend and resistance in a bear trend. Fibonacci retracements are horizontal lines, and all technical analysis software has this tool built in, so they are very easy to use. Join two extreme points, or the high and low points, and the key Fibonacci ratios of 23.6, 38.2, 50%, 61.8 and 100% will appear across the area of this move. Lovely, you don't have to calculate them yourselves. But for me, the most important levels are 38.2 and the 61.8, followed by the 23.6 and then the 50. Note that I do also use a 78.6% Fibonacci level on my chart. I find it less important than the others, but I like to keep an eye on it. Once the 78.6 level has been broken on the move back, remove your Fibonacci lines from your chart and look to redraw them using the new highs and lows. So the next chart shows a swing low and a swing high joined with Fibonacci retracement lines. Note how the Fibonacci lines tie in nicely with previous low points in price. This importantly reinforces the strength of these Fibonacci support levels, as at each level the price has previously jumped higher. So I really do like it when I put my Fibonacci lines on and they happen to tie in with previous lows and highs on the chart. It just makes you believe more in the strength of these levels when everything just ties in. You find this with technical analysis, things just often miraculously tie in when you draw all your lines and your Fibonacci's and everything else with previous price action. The 50% line is not a Fibonacci retracement target or support, but traders use this level because of the tendency of markets to resume the longer term trend after retracing half of the previous move. So as you can see in the previous chart, the 50% line coincides with a good support level. The red ringed area shows how the last time this area was tested, price spiked off this area and the bull trend resumed. Note how this was before the area had become a 50% support level, so we wouldn't have known at that stage that it was a 50% or going to be a 50% Fibonacci support level, of course, because we've not reached the high for the whole move yet. As you can see in the chart, this is an up-to-date example. The last candle on the right hand side of the chart is today's, as I wrote that. Because the Fibonacci lines tie in so well with the previous price action, it gives me good reason to believe this is a short-term top for this market. If the levels were out of sync with the price, as in the example below, it would give me a strong reason to believe we'd not made a significant top in the market, and I would have to redraw the trend lines over a shorter period of time. The same chart below has shorter term Fibonacci lines and appears more relevant because they tie in better with the price action. So once the market begins to pull back, traders can plot the Fibonacci retracement levels on a chart to look for signs of a reversal. Bear in mind that a break below one Fibonacci level will very often target the next Fibonacci support level. You do not know if or when the market will reverse at a Fibonacci level, so as always, we must use a stop loss just below the support. However, it's not uncommon for price to spike a little below the Fibonacci support and then close just above. This would be considered a successful test of the support and could trigger buying in the market. Therefore, it's wise to use a stop around halfway to the next Fibonacci level. In the example above, you can see how the price initially held support 1 at the 23.6% Fibonacci level. Buying here would have returned a nice short-term profit on several occasions. However, eventually a break lower targets the next support number 2 at the 38.2% Fibonacci level. See how initially the price spikes just below this support on both tests. However, the close above coupled with a big blue bodied candle suggests a bounce from here is expected if you placed a buy order at that Fibonacci level with a stop loss around or just below the halfway point to the next Fibonacci level. You'd have seen a profitable trade. In fact, we managed to bounce back above 23.6% Fibonacci on both occasions. Remember, a support or resistance level is only considered broken if price closes outside of the Fibonacci line. A small spike through the support or resistance is common. This is when stop hunters try to shake out the weaker traders and force them out of their positions, but false breaks are common and price can then recover to close just back inside the Fibonacci level. If the price moves more than halfway towards the next Fibonacci support, it is likely to continue on and test it. We can then try longs again at the new level at the next target and support with stops around or just below the next halfway point. However, eventually a break lower. In the chart example, we saw targets to 50% Fibonacci level. Once this is broken, we hit the next target and support number 3 at the 61.8% Fibonacci level. This is usually a strong level. Again, a little spike lower leaves a small shadow or candle wick, followed by a close above the 61.8 Fibonacci level. The next candle retests this support and holds it perfectly. The longer term bull trend resumes from this point, as is often the case with the 61.8% Fibonacci level. So it's often a golden buying opportunity if we do reach that 61.8. The Fibonacci levels also work nicely as targets when the longer term trend resumes. In the example below, you can see how the E-mini S&P recovered from a low after the 2008 financial crisis. Drawing short-term Fibonacci levels on our chart, you can see how the levels worked as targets. A short-term trader would have been able to buy on a break above one Fibonacci level and use the next Fibonacci level as the target for some short-term profit taking. When the price dips back to the Fibonacci level on short-term profit taking, this is an opportunity to buy back into the market and look for the next Fibonacci target. So what I'm saying is you can just trade in and out of these Fibonacci levels sometimes. Very short-term traders or scalpers can use these Fibonacci levels as support and resistance to move in and out of the market if you're an intraday trader. The key to using Fibonacci in a live trading environment is to monitor several different time frames. This is important and pretty much key to what I do. We already understand the importance of this point because we know traders with the biggest accounts are the longer term investors or funds. They have the real power to move the market and even change trends. Therefore, even as a short-term day trader, we must also be aware of the important Fibonacci levels on the monthly, the weekly, and of course the daily charts. Just as you plot your trend lines and moving averages on these charts, make sure you plot your Fibonacci levels, and then we can find Fibonacci areas of confluence. As we know, the key is putting all the technical analysis techniques together across the various time frames to build a picture of the market in your mind and to identify all the important longer term and short term trading levels. Look what happens when we plot Fibonacci levels over a different time period. Now this really is important. This is something I use every single day when I write my reports and when I try to spot trading opportunities. So in this example of the E-mini S&P recovery after the 2008 financial crisis, we start with a monthly chart. We have drawn Fibonacci levels starting at the peak and ending at the bottom of the crash on the left-hand side of the chart. At the bottom of the market, a bullish piercing pattern appears and is in fact the first big blue-bodied candle for many months. This is a clear bullish signal indicating the end of the bear market. Okay, we may not know that that's the end of the bear market, but we do know it's a bullish signal in oversold conditions, and it has to be noted. It is all the more important because it appears on the longer term monthly chart. This is not a signal one should ignore. Okay, if it's on the daily chart, you may not want to base a trade on that, but you may be aware that, hey, bullish candle, I should at least lighten up on my shorts and watch for further bullish confirmation. But when you see something on a longer term monthly chart, you've got to pay attention to it. So this is why you have to study longer term charts. This bullish candle did in fact mark the absolute low of the financial crisis crash. At the bottom of each of the troughs in the recovery rally, we also see very clear bullish candle formations. These also coincide quite closely with the monthly Fibonacci targets. Note, we are using the Fibonacci levels here not only as resistance but also as targets. We expect these levels to be reached eventually, having spotted the reversal of the bear trend to a bull trend with the candle formations. Just by studying the monthly chart, it is pretty clear that the bull trend is developing, with the trough of each pullback clearly marked by a bullish candle at Fibonacci support levels. So we're hitting the support levels, buyers are coming right in, forcing the market back up and creating a bullish candle at every support level. This really does act as very good confirmation that the support level, the Fibonacci support level, will hold. Each new rally breaks above the next Fibonacci resistance and target, so creating a nice steady bull trend. Moving on to the weekly chart below, we've added a new Fibonacci series measuring the low of the crash to the first peak. Note how the price initially pauses at the 100-week moving average in the early stages of recovery. That's the blue line. However, once it's broken above this moving average, it's a further bullish signal, of course. The 100-week moving average then works perfectly as a support area when the market dips back and it's tested twice. That's exactly what should happen in a bull trend. On the second test of the 100-week moving average as a support level, this also happens to be an important Fibonacci support. Check the blue circle. I've drawn a second set of Fibonacci lines at the first peak. Not only do we have the 38.2% Fibonacci support from the monthly lines at 1019, but also the 38.2% Fibonacci support line from the weekly chart at 1007. So this is absolutely key to successful technical analysis. I look for important areas of confluence, such as these where support levels all tie in together. It's key. These are the real important levels that are worth trading. If three good areas were not enough to convince a trader to be buying here, we then get a bullish piercing, almost actually an engulfing pattern, an engulfing candle to form the bounce, to confirm the bounce off the important support area in the blue circle. So if you hadn't already put your buy order in around that 1019, 1007 support area where you get the trend line and the 100-week moving average, you would have certainly got the bullish candle confirmation to show that that support level is holding, and then you're looking to buy into long positions. Note how the 200-week moving average, or the red line, and the first monthly 61.8% Fibonacci level also work perfectly as resistance as the price topped out on its first major peak in the recovery just below here, where you see the red circle. Moving in closer again, we look at the daily chart over the same period from the low of the crash. This chart obviously covers less data than the monthly chart, but we can see more shorter term trading opportunities here. Using the shorter term time periods is like using a magnifying glass, and the short term levels are more relevant to the day trader, of course, because he's looking to be more active and moving in and out of the market. For almost a year, the E-mini S&P experienced a very strong bounce back after the crash ended. If we isolate the period of 1 year from the low in the daily chart below, we can see how the blue 100-day moving average crosses above the red 200-day moving average after just 4 months of recovery in a very positive signal. This is at about the same time as the 100-week moving average is tested as a support level for the first time since the price crossed above it. If these were not good enough bullish signals, we're also testing the monthly 23.6% Fibonacci level at 884, as you can see in the chart above, although a bottom was only reached at 866. Price gains clearly accelerate higher from this point as more traders and investors spot the bullish signals and increasing number of buyers enter the market until we reach a short-term peak towards the right-hand side of the chart. The market has then become overbought and a healthy short-term correction occurs, just as you expect to see in a good bull trend. You can see I've drawn two sets of Fibonacci lines on the daily chart above. The first covers the whole move higher. The second, shorter term set of Fibonacci lines, which are less important because they're shorter term, of course, they're taken from the next significant trough just below the middle of the chart. In fact, just before the 100-day moving average crosses above the 200-day moving average. This second set of Fibonacci lines gives us another set of, as I said, less important targets and support levels, more good for targets, less important for support levels. Remember that the short-term indicators and support and resistance levels are always less important than the longer-term ones. The first short-term Fibonacci support at 1081 intersects perfectly with the blue 100-day moving average. I would therefore consider this to be a significant area of support, and although the price does pause here, this area does little to halt the slide. We continue lower to the next target and Fibonacci support at 1040, 1033, the red circle. Here we have two Fibonacci supports and therefore an area of confluence. That's what we're looking for. We are on the lookout for these key areas of support to buy into longs because we know we're in a longer term bull trend now. This is confirmed on the daily chart with the upward sloping longer term moving averages telling us that we are in a bull trend. Confluence areas where Fibonacci levels over different periods overlap are always more powerful. In this case, the two Fibonacci support levels work perfectly and are located just above the 200-day moving average support to give us even more confidence. And the bull trend resumes, pushing back above the 100-day moving average for confirmation of the longer term trend. To finish off this section on Fibonacci, I will show you how areas of confluence can be seen on just one chart. The typical E-mini S&P daily chart below shows 5 months of price action. You can see how I've begun with the Fibonacci lines at the low point of 1970. This sets out the main short-term framework for our Fibonacci lines. We then break this down looking for the next significant low. Very often this will be at or very close to the 61.8% Fibonacci, so look for that. Look for it each time you draw your lines. I take this as my second point to draw the next set of Fibonacci lines at 2032. I can then take a third point, being the low at 2056. This would give us 3 sets of Fibonacci lines on one daily chart. This is all a short-term trader really needs for day trading. As long as he's aware of the longer term levels, of course, you've got to keep an eye on those, glance at them at least once a week on the weekly chart, monthly chart. The overlapping lines are the areas of confluence which should act as strong support and resistance areas. This is where the trader would wish to initiate trades. The areas that overlap the most include the longer term Fibonacci lines and therefore are of course the strongest. Other less strong levels are used as targets when a level below has worked as support. They can also be used as a guide on where to place stops, those shorter term Fibonacci levels. So place a stop on a long position just below the weaker shorter term level Fibonacci level of support. The overlapping areas of confluence give the trader confidence that the historical support and resistance levels are lining up perfectly and therefore can be relied upon to initiate trades. So you can see in the first quarter, January, February, March, the euro versus the US dollar started to have a little bit of a rally. Let's pretend that we've just topped out in March and we're looking for some support and resistance levels now on the pullback that we're seeing. So the 23.6% can't say that worked particularly well, and we did plunge below the 38.2%. I really should blow this up a bit, shouldn't I? Make it a bit easier to see. That would be a good idea. Okay, so we're looking as if we're trading within this period here. So we've got well, we broke through the 23.6%, which actually did act as a resistance then on the bounce back on this day, as you can see. So there is some credibility in that level, but it didn't work particularly well on the downside. Again, once we broke through the 38.2% fib level, this also worked as resistance. So again, not a great support level, but certainly did work well as resistance. Then we went through to 50%. The 50% isn't really a Fibonacci level. It's just something that we put on the charts because it's a significant a number. Now, 61.8% was in at 105.65. Where did we get to? 105.68. So we got to within a very close range, very close to that 61.8%. As I said, 61.8 and 38.2 are my favorite levels. They do seem to work very often. If you're going to be in a bull trend, if you're going to remain in a bull trend, this is pretty much the last resort. You absolutely have to hold a 61.8. If you fail to hold a 38.2, there is a risk you will trade down as far as a 61.8. And if it doesn't bounce from there, then you are no longer, well, there's a strong chance you're no longer in a bull trend. Okay. So after this dip to close to the 61.8%, the price then really accelerated. We had a strong move higher throughout the summer and right up until the autumn. We topped out in September. You can see the head and shoulders pattern. But I've drawn the Fibonacci lines because we've clearly topped out in September, and there are patterns and all sorts of indicators to show that the euro has topped out and could be turning significantly lower. So on this daily chart, we take the low in January, we take the high in September, and now we're setting ourselves some targets and support levels to monitor. So the first thing that happened was the pair pulled right back to the 23.6% Fibonacci support at 116.78, and hey presto, that worked absolutely perfectly. 1.1667, so we bottomed out within 11 pips of that support level, had a really nice bounce. As you can see, the 55-day moving average caught that. The Ichimoku Cloud. The Ichimoku Cloud indicator can do what a lot of the indicators above do, but in one simple package. The system identifies support and resistance, trend direction, and can also gauge momentum. It was developed by a journalist, not a trader or a technical analyst, and it's designed therefore to be simple to use. When you first look at the chart with the Ichimoku Cloud system, it looks very complicated and like any other indicator you may have seen. But the concepts are surprisingly easy to understand and the signals are well defined. The cloud, or the Kumo, is the most prominent part of the system when you first look at the chart. The Chiku Span A, the blue cloud outline, and the Chiku Span B, the red outline, form the cloud. The cloud is predominantly used to identify the trend. The blue cloud outline moves faster than the red cloud outline and works the same way as moving averages. So shorter moving averages are more sensitive and react faster to price movement than longer term moving averages. When prices are trading above the cloud, the trend is positive or bullish. But in addition, when the Chiku Span A, the blue, is rising above the Chiku Span B, the trend is seen as a stronger bull trend, and a blue cloud is created, which obviously makes spotting this strong trend very simple just at a glance. When prices are holding below the cloud, the trend is seen as negative or bearish, and again, when the Chiku Span B rises above the Chiku Span A, the trend is even more negative and a red cloud forms. The red cloud makes spotting this negative trend very simple at a glance. If prices are moving sideways within the cloud, this is a more neutral scenario, of course. The cloud also works as support and resistance in itself, so the cloud is a support or resistance band area. The outer boundaries of the cloud work as stronger areas of support and resistance, but the whole cloud will also work as support and resistance. Its calculation shifts it forward by 26 days, and therefore support and resistance areas at the edges of the cloud are projected into the future, which is obviously quite useful. You can see where the support and resistance levels are as you look forward. So you can see in the chart above how the cloud has worked perfectly, providing support throughout the period in the bull trend. Chiku Span is the black dotted line you see in the chart and acts as a sentiment indicator. So simply, if the Chiku Span or the black dotted line is holding above the price action, this is seen as positive and bulls have control of the market. And then of course, if the Chiku Span is holding below the price action, it's seen as negative, bears have control of the market. Because the cloud is the most visual part of the system, it's easy to focus on this and pay much less attention to the other parts of the system. But crossover signals are equally important. Both the price and conversion line crossover of the baseline provide trading signals. So the thick blue conversion, or the Tenkan Sen line, works very much like a 9-day moving average. The thick red base, or the Kijun Sen line, works very much like a 26-day moving average. In fact, these are easy to calculate manually, as they are simply the average of the 9-day high and low and the 26-day high and low, but you won't need to calculate them manually. It's just like the 9-day moving average, the conversion line reacts more quickly to movements in the underlying price than the slower baseline. A crossover of the price above the baseline is used to give a buy signal. In addition, a conversion line cross above the baseline, just like a moving average crossover, is used to generate another buy signal. So pretty simple if you already have studied our moving average crossovers and signals. A crossover of the price below the baseline is used to give a sell signal, just as it is with moving averages. Another bearish signal is when you get the conversion line crossing below the baseline in a bear trend. Okay, that's all pretty simple. I find that the baseline itself can also work as support in a bull trend and resistance in a bear trend. Now, remember, we are only looking to buy on a bullish signal when the prevailing trend is positive, and vice versa, we're only looking to sell when a bearish signal is given when we are already in a negative prevailing trend. You must know that by now. If price breaks below the cloud, this is a negative bearish signal and indicates the bull trend has been broken. And of course, if price breaks above the cloud, this is a bullish signal and indicates the bear trend has been broken. You can see how the Ichimoku Cloud is designed to give indication and strength or momentum of the trend. Price trading above or below the cloud and the color of the cloud itself allow the trader to quickly read these signals with just a glance of the chart. A blue cloud also works as a support zone in a bull trend, and a red cloud works as resistance in a bear trend. So bullish signals, just to recap. The Chiku Span holding above the price action, that's bullish. The price moves above the cloud to indicate a bear trend has ended, that's bullish. The cloud turns from red to blue to indicate strengthening bullish momentum. The price moves above the baseline, the Kijun Sen. And the conversion line moving up above the baseline, just like a moving average crossover, this is a buy signal. Bearish signals are opposites. Of course, the Chiku Span holding below the price action is bearish. The price moving below the cloud to indicate a bull trend has ended is bearish. The cloud turns from blue to red to indicate weakening momentum, or as I've written here, strengthening bearish momentum. Price moves below the baseline, that's also negative. The conversion line moves below the baseline is a sell signal, just like a moving average crossover. So note, just like moving averages, the Ichimoku Cloud system does work well in upward or downward trending markets, but does not work well in a market that is trending sideways and is likely to throw out many false signals.